markets are moving. And of course, on a Sunday, it gives us the opportunity to sort of cast our horizons a little bit longer. And on this day, the first session of the year, we're going to try and cast our outlook for far into the future of the year, the first half at least, depending on where our two special guests are comfortable. Let's kick off with Christof Rühl, Senior Research Scholar at the Center of Global Energy Policy at Columbia University. Christof, there's certainly been a vibrant start to the new year. Oil prices have continued their sort of climb, although somewhat steady over the last few sessions. But nonetheless, the year from a market's point of view seems to have continued where it left off last year. How do you see the big themes for 2021?
Morning, John. You can see a very early morning still here. It's the New Year's tend to continue like old years finished off in all respects. So I think I would make 3 points. I think the overarching, the big question for 2001 is the economy now. There's no way around it. I don't remember about yourself or others, but I'm sure many of us, myself included, made the prediction last spring that we wouldn't see lockdowns again, no matter what happens to the virus. And then when the lockdowns tightened again globally in the fall, we made the predictions, oh, they won't affect the economy so badly. By now, it seems clear that this second wave of the virus is not only much more deadly than the first one, but also that we have sort of in a virus, in a corona alley, as they say, with the hope for vaccines on one side and the modifications of the virus on the other. And the impact of the economy is starting to be felt again. And at the same time, we have, because of the vaccine, everything lined up for a big burst in expenditures by the summer of this year. And any analyst under the sun I'm aware of predicting glory, to economic growth and to the stock market. So much so, unanimous optimism that something has to go wrong. And what can go wrong, of course, has to do with all this huge savings and pent-up demand, that this will translate into a burst of inflation. And that this burst of inflation will shift expectations, and that creates long-term damage. That is a very serious possibility. Beyond 2021, we are in an unprecedented, totally uncharted territory with the amount of money which has been created and with the global debt which has been created. And I've gone through these numbers over the Christmas break, and it's terrifying. There is just very little room to maneuver to get out of this without, raising interest rates, causing a financial crash, or having inflation rates raising interest rates, and in both cases after the financial crash having a recession. It looks very dire in the long term. And serious voices like the ex-chief economists of the BIS and others are now saying that maybe, just maybe, monetary policy over the last 20 years has just been stoking up a big disaster. It was really wrong. The second, when you look at energy markets, it's interesting what's happening now, also over the winter, with this explosion of natural gas prices in Asia. That's a temporary bottleneck and the kind of adjustment to a crisis situation, by all sorts of individual sources. But behind it is also a shift in demand as China starts to get away from coal and is just having an official policy of gasification, of shifting more into gas. And they have been not very successful on the supply side of that policy, which is to create gas resources domestically. China sits on the biggest, not the US, China sits on the biggest proved shale gas reserves of the planet. But they haven't been successful in getting to that, but they have moved ahead nevertheless, and that contributed to this crunch on the demand side. And how China will continue with that mixture of high economic growth and then the promise to decarbonize by 2060, I think that's going to be another feature which will determine 2021, in addition to all the policy changes which we have in the US and in Europe. And then finally, on our beloved oil markets, I think OPEC Plus has done a really remarkable job in holding the line and in draining US inventories. That really looks good. I think I have to defend Mike there in this original forecast, maybe not as glorious as we first thought, but nobody knew how bad the demand situation would be. But it looks very good, very promising. And now the old saying applies, no good deed goes unpunished, because now we have prices in the range where you see shale coming back and other private producers coming back. And that's what I and others have been preaching all along. This is not a winnable strategy. It's hard to see, it's impossible to see how prices should stay north of 55 without a very glorious economic spurt of growth.
Well, they're certainly going to be locked in at that number, because it seems like the shale producers are hedging so that they are protecting that forward price. Mike Muller, head of Vitol in Asia, thank you and welcome back. Happy New Year. Your thoughts in the sort of big picture outlook for the year ahead? A lot of the big themes, as we mentioned, have already kicked in the new year. We had OPEC meeting last week. We had obviously this issue on shale. We got a big stimulus announced by the new government coming into Washington. Your thoughts for the year ahead?
Christof's done such a great job setting the picture here. I'll just try and complement what he said rather than build on anything new. We have indeed a market where OPEC Plus have kept control, and it hasn't been without speed bumps, as I put them at times, and without tension. But what really took the market into the mids and briefly even into the high 50s, with a peak of 57.42 for Brent. Who would have thought that? $57.42 on the 13th of January was the Saudi decision to unilaterally take 1 million barrels a day off the market in order to send a signal that they were responsive to the latest wave 2 or wave 3 virus demand impact, but also, I think, a shot across the bows of their fellow OPEC Plus members that they'd better stay on their numbers and not let things creep, as has historically been the case so often when prices have gone higher. The temptation to put more into the market because the market is asking for it has been so great. And that really has been the driving factor. So the big picture for energy, and let's start with oil here, is that we suffered a draw, which the analyst consensus now is about 9 million barrels per day for the year 2020 versus 19. And this year, we're going to see a great big demand surge. And by the end of this year, we think we should see in excess of 6 million barrels a day more demand than in 2020. And that is a massive shift. So 2 years in a row where the supply and demand balances have just been off the scale compared to anything we've ever seen before. And how we navigate our way through 2021 to respond to that demand change is going to be the big challenge. And what makes it even more interesting is that people are not united in their views on this. Some prominent advisory investment banks are suggesting that by summer everyone's going to be jumping on planes again, and there's going to be this pent-up demand of, you know, going to your Instagrammable holiday locations and catching up on what you couldn't do last year in 2020, putting all the jet demand back. And it is really jet fuel that is a big, big lump of that demand that's gone missing. You could argue it's 3 million barrels a day, or roughly half of that demand recovery I'm talking about for 2021. And then, of course, you've got the huge phenomenon, which Christof alluded to in terms of natural gas and power markets, where you have unseasonally cold starts to the year in parts of the Northern Hemisphere. People are using the term polar vortex again, which we hadn't heard for several years, La Nina weather effects and all that. And nowhere was this more apparent than in Japan, which has a newly launched futures exchange for power. And boy, did it go. I mean, the chart was a ridiculous spike caused by cold weather and low inventories. And for markets which have policies to have buffers in place, such as Japan, Korea, to essentially run out of fuel in localized terms and start trading power at prices that are equivalent to many hundreds of dollars per barrel of Brent equivalent is unprecedented. And just to put some numbers on it, the LNG benchmark JKM price, which was hovering in single digits only at the beginning of December, shot up to a peak trade of $39.30 per MMBTU, which, I mean, take your pick, that's in excess of 200 and something like $50 a barrel equivalent or something like that. But it's already now moved on. The trading month of February is over. That was for a mid-February cargo. And now we're talking March, which has dipped just below 10 again. So these markets are incredibly, incredibly volatile and fundamentals driven.
And so can you just interject on that?
Yeah.
Last year we had the WTI experience of dropping negative. Now we've had this LNG scenario, and you know, of course, as you say, there's more demand, a special situation in Japan. Yeah, okay, let prices climb a bit, but we're seeing this sort of dramatic, sort of, as you say, off the charts, illogical or not. My question ultimately is, these are two moments in the last 12 months in which energy markets, this case gas, last time oil, have just been completely shocked by unprecedented, I'm wondering, does that say anything to you about the outlook of where these markets are structurally weak?
Well, we do have a market that prices off the marginal barrel always, and where people keep inventories tight for cash management reasons, and it's very understandable that people are going to be behaving that way in the current stressed economy. This does lead to surprises. It's been a very long time since we've had a cold winter to contend with, not just in Northeast Asia. I mean, look at how Spain was blanketed in snow also recently. So the gas markets are pricing to respond to that. And it is now fair to say that whilst a week ago we had Asia sucking gas from all over the world, now Europe is setting a price for gas, or had set a price for gas that was designed to prevent gas leaving Europe. But these weather statistics are very, very important, and I think meteorologists are in strong demand right now.
Well, I think it's very important to remind people. I mean, these have been, as you said, very unprecedented events, and they have mostly been exogenous shocks, as they say. Meteor hitting the earth in the form of the pandemic. I think it's terribly important to remind people that these prices are actually key to adjust and to deal with the situations. The light didn't go out in Japan, and oil production didn't completely collapse after the pandemic. And so because I was reading an article in the FT the other day, how terrible the world is we live in, because somebody in Tokyo opens the windows to let fresh air in a restaurant. It's now apparently is law because of COVID. And in England, the consumer has to pay a higher gas bill. We could be grateful that we have this kind of integration, because otherwise these systems would not have been capable of dealing with the situation. And I'm saying this because going forward, I can just see the people crawling out of the bushes and say, oh no, we need to regulate everything and prices are too volatile. Price volatility in reaction to extreme circumstances is an extremely valuable thing to have.
Yeah, they wonder what the legacy impact of that will be, and it's still obviously playing out. Christof, the other big element for the year ahead is politics, geopolitics, new government in America, new leader, coming in Germany, Europe's biggest economy and biggest political heavyweight. So these two developments, how do you see them impacting the direction of this year?
Mostly through geopolitics and then through the economy. And the geopolitical part is actually relatively easier to predict, because I think that Biden now having control over the Senate will move ahead and will try to implement as much of his agenda as possible. And for us in energy markets, this means a green agenda in the US, but without rocking the boat. So he will not shut down shale or anything like that. And that means reconciliation fast with China and with Europe in terms of trade and general geopolitical cooperation. And it also means that he will move forward with the nuclear agenda with Iran, trying to get that back on track. It depends a little bit on how the Iranian leadership reacts. What still boggles my mind is the uncertainties which are on and Germany, of course, whoever the leader will be, trodden the way and will fall into line as long as that line is deemed sensible, which Biden's line seems to be different from Trump. The big question marks are on the economy. I mean, this is really so. Imagine we had this pandemic, we had this government in the US, for example, where numbers are best, doling out money. It turns out the US economy, just as an example, is about 15 trillion in size, give or take one, about 15 trillion it says. It turns out that so far this year, over the first 10 months, additional savings in the hand of the populations are 1.5 trillion. This is money which they didn't spend on vacations, holidays, bars, and so on. And that's money which people got, especially on the lower end of the income distribution through these stimulus checks. This is the wall of money which drives equity markets up. These guys sitting at home and investing everywhere. This is the wall of money which may now hit an economy which has supply constraint and which may result in inflation. In the background, we have record debt and record high money in circulation, and central banks who are unwilling, and by now probably they cannot increase interest rates. So what will happen if you have inflation? You cannot really raise interest rates without creating a recession and deflating all that debt which is around there. You have a financial bubble and everybody will scream, and again, you cannot raise interest. They have lost their major instrument against recessions, which is lowering interest rates, because interest rates are at zero. That's what caused that situation. That had to be done. I'm not criticizing that. The reaction was the only one available. But in the long term, as I said earlier, it starts to look very worrisome, very unstable, the economic situation more than the political one.
Yeah, Mike, the point you made earlier about OPEC and Christof referenced as well, done a great job, etc. I'm wondering your view on the decision last week. I would be a little bit concerned about the outcome of last week's decision, in the sense that it's quite a choreography. You go ahead and increase Russia, but we'll hold back 1 million barrels. My point is, ultimately, it's not a cohesive decision by OPEC as they had we're going to increase 500,000 a month. It demonstrates that they couldn't find some sort of cohesive decision within the group to move forward in a pro rata basis, etc., to collectively manage the situation that they face. And we have this exceptional situation that Saudi Arabia has taken this step. I'm just wondering, does it give you any cause for pause to think how this group survives the year when we started with this very strange choreograph?
Well, my view, Sean, is that momentum remains on this, because unless we see an unthinkably ugly manifestation of the virus somehow defying the vaccine, the big picture is that the tailwind is behind OPEC Plus. And all the messages, including at your very expertly run 13th of January, what should we call it? Where you had people like Mele Kyari from Nigeria and Sohail Al-Mazroui of the UAE. They are complying and they plan to remain in compliance. You take a headline I saw just today about the Iraqi oil minister saying that they do not plan to come back asking for a bigger share of the pie. All this points towards an OPEC Plus that is not in tatters in any way at all. And it looks like, unless we see very disappointing demand numbers coming through, things are manageable, because OPEC are looking at forward demand projections that allow them to resume their 500,000 barrels a day supply addition to the market from, let's say, April. And some people are talking about there being a need for shale production to actually produce a little more than the 11 and a bit million barrels a day total US production that is the case right now, in order for the world to have enough supply to cater for the peak demand period in Q4 this year. And of course, there's also speculation that is now rife that Iran could feature in that time frame also, given Joe Biden has just, or his administration have just announced that he plans to sign 12 executive orders on day one in office. So lots and lots of things up in the air here. But the main answer to your question, Sean, is OPEC should be able to navigate anything other than the most unexpected virus forward path. And I think a lot of the difficult decisions are behind them.
Mike, just to follow up on that, just to take a view on China, year ahead, China numbers coming out this week for the fourth quarter expected to be, trending up around 6%. What's your sort of big picture outlook for China this year and its sort of demand outlook for oil?
Can I just inject before going? Oh, sorry.
Go on, Christof.
Go ahead, Christof. Sorry.
Just inject a word on your previous question.
Yeah.
Going to China. There is something about this OPEC, Saudi additional cut, which is curiously not often mentioned. When you go back to the beginning, to the April meeting, Saudi Arabia came out of that producing at record levels. So normal times they produce 10.5 million barrels, and they keep 2.5 spare. Because of that so-called price war, they were actually producing 11 plus when the cuts hit. So they cut from a level which was much higher than what would be considered normal. So all along for the rest of the year, they must have felt like, oh, we got away cheaply, because they were producing still 9. Russia cut from the normal production level and must have felt, oops, we are actually biting more of the bullet than the Saudis do. And I think against that background, it was comparatively easy for Saudi Arabia to say, now we're going to give you another 1 million for 2 months, because precisely for 7 or 8 months before, their production was 9 instead of the 8, which would have been had they cut 2.3% from their standard range of production. I think that's an important consideration. I wouldn't exclude that they have synchronized that as well. Otherwise, I agree with Mike. The big growth spurt in 2021 in the summer will lift all boats, and then the trouble comes later when shale is hedged. On China,
I fully agree, Christof.
well, that's a rare occasion.
No, we want to just quickly turn to China as a kind of last subject before we run out of our half hour. Maybe kick off with you, Mike, on that, what you're seeing from Singapore.
Okay, no, in your pre-reading, you put a nice article there that showed that the demand prediction for Q4 GDP growth in China was back to trend line, 6.5 or 6.7%, underpinned by a very strong growth in exports, 17% up year on year. And whilst your article attributed it to protective clothing and virus-related plastics, it is actually across the board. Just look at the rates for container ships, Trans-Pacific. Look at the volumes of fuel being bunkered in Singapore Harbour, up 6% year on year. There was a lot of indication there that China has been motoring ahead. That said, for oil in particular, well, one last statistic: Chinese consumption of LNG has also surprised to the upside. It has been a huge uplift of, I think, close to 30% year on year demand for LNG also. But I think it's fair to say that these parts of Asia that have been relatively virus free have done their bit. They've run their leg of the race in terms of growth, and the world is now looking to the Western Hemisphere and those parts of Asia that are still beset by the virus to take up the baton and to join the China growth story as things surge on here. So the big warning sign about China, and we're between Western New Year and Chinese New Year here, is that on the energy front, and oil in particular, China's been relatively quiet. Any crude oil trader will tell you that the Chinese SOEs and the Chinese independent sector has been buying less crude than expected. And that can point to a number of things: overstocking, or maybe, just maybe, the demand lashback from the shutdowns of those two high-profile cities in Hebei province, which is the province that wraps its way all the way around Beijing, the capital Shijiazhuang, which has a population of something like 15 million inhabitants, and thereabouts, and Qingdao, which is about as big as London, locked down completely to roll out a testing program, which is something we saw in Qingdao port about 2 months ago, when they did the exact same thing for 11.3 million people. When China locks down a city, people don't drive, there is no demand. So there is some early evidence here that the demand for gasoline in particular has been a little bit lower than expected, and therefore China may have run its course if this happens in more cities. And you then start looking at the case count. Of course, this is a pinprick compared to the statistics coming to us from the USA and Europe, but if you get 100 cases in Heilongjiang province or in Hebei province on a continuous basis, China will continue to try and snuff it out, because of course this is the high susceptible season, and they do not wish to see the virus take root a second time in China and impact the economic growth story. So we think China is petering out in terms of demand, and the rest of the world needs to take up the baton in terms of demand.
Christof, your thoughts? Again, China played the critical role last year as the sort of sustained engine of global energy demand and economic performance. What's your thoughts on an outlook for China and Asia this year?
Unless there is some hanky-panky going on with virus numbers, they took them forever to leak this WHO delegation in. They have another 22 million lockdown, as Mike just said. But unless there's some serious sort of misinformation, then China should grow very fast. Has a head start over the others. As we have emphasized on the economic side previously, it's still an export-oriented economy, so it will benefit from this jump in demand and it's prepared to do so.
We're having problems with Christof's line. I think Christof is frozen. Let's bring in the survey question while Christof unfreezes and get people's views on the outlook. Sorry, Christof, you froze there. We'll just get the survey question, Irene. There we go. So basically, Brent crude oil prices are more likely to reach $60 a barrel in Q1 than drop back to $50 a barrel. We got all of our forecasts last week for the year ahead, which very much was consensus around $50, although there was a good part of the voting last week also towards 60. But I'm just looking at the first quarter here. Brent crude oil prices are more likely to reach $60 a barrel in Q1 before then drop back to $50. What's the view in the room? Agree or disagree with that sentiment? And we'll go to the panel for their sort of harsh predictions for the year ahead. Christof, just to give you a chance to come back on that point.
I'm unfrozen. It's cold outside.
You're unfrozen, yes. I know it's cold outside, but
it's full of snow. So very short, unless there is some hanky-panky on information or spread of new virus in China again, a somewhat bigger caveat than in Europe or the US, because it's still an opaque situation. China ahead. And we have said earlier, China is still a big exporting economy. So in addition to being in position right now, because they had the virus more under control than others, they will benefit from the surge in demand, which we see coming as these extra savings gets unleashed in the rich parts of the world, in Europe and in the US and in Australia. On the oil demand and energy side, so one has to differentiate. The oil demand side, I don't think this will translate into an exceptional jump in demand, because that we have seen already earlier. Also don't think that the relatively moderate demand numbers we have now are the result of the last lock-in, because the numbers for that are not in yet. It's too recent. So what I think we're seeing there is good old destocking, because China undoubtedly, and everybody drove that point home, used 2020 to build up inventories, and now they must be filled to the hilt, and nobody knows, but it's the common perception. I think that makes some sense. On the natural gas front, it's a bit different, because I said earlier, there is a national program in the context of the target of the decarbonized China by 2060 to switch out of coal and into gas. They messed it up twice, because the supply side isn't forthcoming, so we should more efforts in creating domestic gas, including shale gas, but also because of the timing. You don't switch your demand in your households shortly before winter when you don't have enough supply. That's why this is a temporary price spike, and at the same time, it's a harbinger of things to come. So the demand for gas will continue to stay high, and that will affect global energy markets positively. So that's the energy.
Let's get the survey result before Mike having the last word. So kind of split room here. Brent crude oil price more likely to reach 60 a barrel in Q1, then drop back to 50. Mike, you've in your last comment, I welcome obviously your final word, but in your last comment, Mike, and generally, I think in consensus with the overall expectation of 2021 is going to be the bumper year recovery. We had Emirates Airlines announcing yesterday that they're going to have their full fleet back in the skies by the end of the year. That all said, what gives you pause that could derail this? What would be the thing that might be not necessarily the black swan, the unknown, but what's out there, do you think? Clearly, this second COVID strain is causing great duress. There are some big challenges still on the logistics of the vaccine. What do you think is out there that might derail this sort of generally accepted narrative that 21 is a 6 million barrel a day demand recovery, positive economic outlook year?
I think it was summed up nicely on the 13th session that you held, Sean. It's the rollout of the vaccine. And of course, we now have three unruly strains that are more contagious, the British one, the Brazilian one, and the South African one. And it is really a race against time in some parts to get the vaccinations rolled out to hit the vulnerable parts of the population and the interventionist parts of the population, in other words, nursing and hospital staff, to contain this whole thing. And therefore, when I say the race is on, the race is really on for the summer season, when in the Northern Hemisphere, the virus tends to be less contagious, less prevalent. That's just how viruses are. And whether it's going to come in time for people to actually do what you say and unleash that pot of savings to go and travel and do things and stimulate those parts of the consumer economy or not. And I have my doubts whether places in Asia, such as Singapore, where I'm sitting, will be happy to throw open the doors to tourism and travel, given the high density fabric of society here. But then again, Singapore's role in life is a commercial center which serves as a transportation and a business hub. So its lifeblood is travelers, Changi Airport, conferences, etc. So it's going to be a very interesting dynamic to observe. Just looking forward, Chinese New Year is around the corner. It is going to be very important to see whether your average Chinese city-dwelling employee travels home to his family or not. And there's been quite a lot of instruction or urging or recommendation from employers for people to desist the temptation to do so. There's even rumors that some people have said they'll deny people their bonuses or their paychecks if they are found to have traveled home and put the country's health at risk. I don't know whether that's founded in reality or whether that's just gossip, but whether or not people travel around Chinese New Year is a huge deal. And I heard anecdotally somebody saying that bookings for domestic flights in China could be down 50-60% on this time last year, which is a remarkable statistic, given that the virus was already in full flow this time last year in China. So again, a pinch of salt there. And of course, this time next week, we'll know what Joe Biden is going to do in terms of how hard he puts his foot on the green accelerator button. Let's not forget, this is the year of COP26. And this is a very, very curious year where we have Tesla worth more than all oil majors put together, and where we have all sorts of companies people never heard of before, such as Ørsted in Europe, being bigger than BP by market capitalization. These are unprecedented times. Whether all that's going to unwind as we go back to normal again, or whether indeed we're here to stay and new energies have it. And with it, carbon trading and emissions trading becomes the big new thing that we're all going to be in pursuit of.
Well, there's certainly no shortage of things to be considering over 2021. And the one thing that we didn't mention in any of our conversation is the wild card that is the ever Donald Trump. Coming out of office, and given what happened in the US on the January 6th, I think one has to factor in that could be a wild card of great potential disruption in the year ahead. I would also point, as I did earlier in my comments, I do think that OPEC's decision last week that showed some fracture to me, that Saudi felt it had to go alone in a cut of 1 million barrels a day. I think that signals challenges ahead for OPEC Plus in 2021 to navigate even the wind of recovery, where people disagree to the scale in which the recovery can allow more barrels to come into the market. So I think there is something to watch there. We'll have to see how it plays out. But nonetheless, Mike Muller, as always, thank you very much. Kick off the new year. Happy New Year to you, to Christof as well. Happy New Year, and thank you very much for your insights. And for the 50-odd people who joined us today, thank you very much. And for everybody who joined the forum last Wednesday, I hope you found it useful. All of that content is posted on the Gulf Intelligence LinkedIn event page, where you can see all the sessions if you want to go back and visit the ones you weren't able to attend in real time. So thank you very much. Cheers, Mike. Cheers, Christof.
Bye, Christof. Bye, Sean. Thank you. Nice snow out there in the Black Forest.
Yeah, cold. Good for oil. Well heated here.
Okay. It says we're still live. All the best. Bye.